The 15th of January, 2026, Thursday morning Eastern Time, deep night in Asian markets. On many people, S candlestick charts, this is an extremely ugly long bearish candle. Within mere minutes, silver prices plummeted from a historic high of $92.23 into the abyss of $86.2. Free falling. Countless retail accounts blew up at this moment. Stop. Loss orders triggered like dominoes. Forums filled with rage, despair, and cries about manipulation. But if you could temporarily close that flashing red-green trading interface and dissect this corpse with surgical calm like a physician, you'd discover this wasn't T-Chaddock stampeding at all. This was a precise, cold, even perfect surgical strike. We must first ask ourselves the most intuitive yet easily overlooked question. Why today? Why this specific $92 price level? Is this merely an ordinary technical correction? Superficially, it appears so. Overbought RSI, excessive deviation rates, profit. Taking textbooks would give you 1,000 reasons. But if you open overnight repo data from bond markets, then cross-reference options market open interest distribution, the answer is clearly negative. This is absolutely not coincidence. This has nothing to do with fundamentals, even nothing to do with silver's industrial demand itself. This is pure mathematical gaming. Note the calendar, the 15th of January, 2026. This day sits just one step from the critical monthly options expiration. OPEX. At the $92 level, commercial banks, the market makers we're discussing, have accumulated extremely massive call option, short positions. This introduces one of finance's most brutal mechanisms, gamma squeeze. Once prices effectively break and hold above $92, according to the Black-Scholes model, market makers must buy more silver in spot markets to hedge risk. The higher prices go, the more they must buy. This forms a self-reinforcing positive feedback loop. Buying causes rises, rises cause more buying. For commercial banks holding massive short positions, this loop doesn't just mean losses, it means solvency. S termination, so you witness that double tap. This isn't T-retail selling, nor miners hedging. Only institutions with unlimited liquidity supply privileges can, at moments of weakest market liquidity, often the overlap between London lunch and New York opening, instantly dump paper contracts equivalent to twice global annual production. What motivates this behavior? Simple. They must cut the fuse. They must not only stop price rises, but create panic, driving prices far from that $92 critical point triggering nuclear explosion. This isn't T-trading. This is defense, violent defense for survival. When prices dropped $6, if you are a newly entered investor, you might ask, does this big bearish candle mean silver's bull market logic has terminated? Does the crash mean markets no longer need silver? Quite the opposite. If you dig into COMEX inventory reports and SLV silver ETF fund flows, you'll see a completely different picture. It is like watching a magic show. The magician makes you stare at his left hand price crash, while the real action happens in his right hand physical delivery. While candlestick charts collapsed, spot market premiums quietly rose. What does this mean? It means, though, paper silver on screens got cheaper. Buying an actual physical silver bar in the real world requires paying higher premiums. This reveals a truly terrifying underlying transmission mechanism, the fracture between price and value. Wall Street elites, using algorithmic trading, created massive phantom supply in derivatives markets. This supply only exists in servers, binary code, not in any vaults. By dumping massive amounts of these paper promises, they successfully suppressed prices. But here is a fatal paradox. The lower prices go, the bigger physical demand appetite grows. For entities like Tesla, Apple, and frantically building data centers, silver is a financial chip for speculation. It is indispensable industrial lifeblood. When you forcibly suppress prices from $92 to $86, you are actually issuing discount coupons to global industrial giants. T regulators and bankers know the consequences, of course they do, but they re-trapped in a classic prisoner's dilemma. If they don't suppress prices now, options market chain explosions will immediately destroy their balance sheets. If they suppress prices, they accelerate physical inventory depletion, triggering fiercer rebounds in the future. They chose the former. As an old saying goes, if you owe the bank $100, that is your problem. If you owe the bank $10 billion, that is the bank's problem. And now, the entire financial system owes physical markets hundreds of millions of ounces. They can only choose delay, using today, crash to purchase tomorrow, survival time. Now let's shift from macro games to micro individuals. On this bloody Thursday, what does this drop actually mean for ordinary investors' wallets? Many see shrinking account values, the pain of stop, loss exits, but in seasoned strategists' eyes, this is actually a textbook deleveraging event. Markets are extremely efficient wealth transfer machines. They always transfer wealth from impatient hands to patient hands, from leveraged holders to spot holders. In this $92 to $86 process, who truly got hurt? Those speculators trying to get rich overnight with 10 times, 20 times leverage. Their positions were force, liquidated within minutes, becoming fuel for market makers covering shorts. Why does Wall Street need this cleansing? Because only by washing out uncommitted ships, kicking passengers off the train, can the locomotive more nimbly drive toward the next highland. This sounds cruel, but this is precisely financial markets' jungle law. But does this mean you should feel fear? That depends on which side you sit. If you are a speculator trading on candlesticks, today is undoubtedly catastrophic. Your technical indicators failed. Stop, losses pierced, confidence shattered. But if you are an allocator watching supply, demand balance sheets, everything happening today is merely a liquidity discount. Remember this, in this turbulent era, any asset instantly generated by mouse clicks, like fiat currency, bonds, paper gold, is becoming increasingly fragile, while assets that cannot be printed, cannot be algorithmically generated, are becoming NOAA S-ARC. When screen red glow gradually fades, the $86 price stands like a tombstone on Thursday. As closing line, retail licks wounds, media busily seeks cliches like Fed rate hike expectations or geopolitical cooling to explain this crash. But if you are a seasoned insider, you know these are just smoke screens for the masses. Real wars never happen in CNBC studios, but in dark pools and balance sheet footnotes that even satellites cannot spy. In this $6 hunt, who is shorting at any cost? And protecting whom? First, we must resolve a core confusion. Are short sellers shorting because they re-bearish on silver? This is a massive misconception. Usually we think if someone sells something, it is because they believe it is worthless. But in precious metals derivatives markets, logic is completely inverted. The protagonists in this $92 defense battle aren't T-hedge funds or macro speculators, managed money. According to Deep CFTC Commodity Futures Trading Commission, Commitments of Traders Analysis, the true short commanders are that handful of behemoths called commercials swap dealers, typically a few top market makers with SIB Global Systemically Important Bank titles. Why do they hold such astonishing net short positions when silver fundamentals are so strong? Can their analysts see exploding photovoltaic industry demand? They know AI hardware needs massive silver. They certainly know. But they helpless. As market makers, their duty is providing market liquidity. When global investors, hedge funds, and retail frantically buy call options, who must sell those options? These banks. This means the more bullish the market, the larger the short exposure these banks are forced to swallow. By the 15th of January, when prices approached $92, these banks found themselves trapped in a nightmarish mathematical trap. The hundreds of billions in notional value call options they sold were about to enter in the money. If prices merely maintain $92.23 before Friday closing, according to option contract regulations, they have to deliver massive physical silver to counterparties or pay astronomical cash differences. So is this greedy plunder for profit? No, this is more fundamental than greed. This is a balance sheet defense war for survival. If you had to choose between instantly losing $5 billion cash flow and using HFT algorithms to instantly suppress prices, which would you choose? For Wall Street, decision makers, this doesn't even require meetings. Those empty sell orders flooding out in those minutes weren't essentially selling, but firefighting. Even using most expensive champagne to extinguish fires is cheaper than letting the entire building, bank solvency, burn. This raises the next sharper question. Regulators have omniscient eyes. Every order placement and cancellation is monitored. Why do they choose silence on this obvious price anomaly? They know this destroys price discovery mechanisms. Of course they know. But here is a word more advanced than fairness, stability. We must understand the world map and regulators, like Fed or Treasury. Eyes on their maps, silver price fluctuations are just tiny coordinates, while major commercial bank liquidity is the table supporting the entire map. Imagine if regulators intervened, prohibiting this naked short suppression, what would result? Silver prices might instantly soar from $92 to $120 or higher. Immediately after, one or two top banks holding massive short positions would face unpayable margin calls. This would cause what? Repo market defaults, liquidity droughts, possibly even triggering Lehman moments like 2008. Must all silver longs' interests be sacrificed to save one bank? In this brutal system, the answer is usually yes. This is decision makers' dilemma. They not just referees, they field maintenance workers. When they discover game results, price surges might cause field collapse. They tacitly permit one side. Shorts, to pause games through fouls. This silence itself is a massive signal. It tells us current financial systems are too fragile to withstand real asset prices. If silver's real price were released, its shock waves would be sufficient to shatter paper currency system credit foundations. Therefore, price suppression is no longer merely commercial behavior, it is even elevated to some degree of financial stability maintenance. Since this is a counterattack triggered by shorts cornered into desperation, is history rhyming? Is this merely a remake, the 1980 Hunt Brothers squeeze? That year, Hunt Brothers tried hoarding silver against the Fed. Ultimately, Paul Volcker, through crazy rate hikes and exchange rule changes, directly destroyed Hunt Brothers, leverage, crashing silver from $50. Current shorts obviously expect the same script, just knock prices down, longs will collapse and exit like Hunt Brothers. But this time is truly different. This is a war in completely different dimensions. 1980, longs were speculators. Speculators can be eliminated because they buy silver to sell for profit. As long as prices drop deep enough, they LL stop. Loss, who are 2026's main longs. Look at buy. Side sources after this crash. Not Wall Street fund managers, but global supply chain procurement managers. This is industrial capital versus financial capital. You can force a speculator to close positions, but you cannot force a photovoltaic panel factory to stop production. You cannot force an AI data center training large models to stop procuring high-performance conductive materials. For these industrial buyers, silver is T numbers on candlestick charts. It is indispensable atoms on production lines. This constitutes shorts. Most desperate landscape, every paper silver short contract they dumped Thursday not only didn't T-scare opponents, but became discount gift packages in industrialists' eyes. Back then, the Fed could attack longs by raising rates, increasing gold, silver holding costs. But today, no matter how high rates go, industrial production must continue. This is inelastic demand. When inelastic demand meets artificially suppressed false prices, there is only one result: accelerated worsening of physical shortages. So let us summarize core logic. This is an asymmetric war. On the surface, price. Commercial banks won. Using capital advantages and rule loopholes, they successfully knocked prices from $92 back to $86, temporarily preserving options, expiration day, golden body, avoiding immediate balance sheet explosions. In the shadows, chips, they re-losing miserably. In this chaos, true hard currency, physical silver ownership, is transferring at unprecedented speed from financial institution vaults to Eastern warehouses, tech company reserve depots, and private fortresses of those who see through credit currency nature. This is in T-card switching, this is getting robbed blind, bankers defended, quotes, but lost inventory. And in the commodity world, there is one eternal iron law. When inventory zeroes out, pricing power no longer belongs to those with printing presses, but those with physical goods. Since we've seen who is shorting and why they risking death to short, as individuals swept into this torrent, the next 72 hours are crucial. Markets have signaled, but most are still watching wrong indicators. What to watch this weekend? Sherlock Holmes once said the key is the dog that didn't T-bark in the night. In financial markets, this indicator is called backwardation, spot premium. You only need to do one thing: observe the spread between spot and futures prices. Normally, futures prices should exceed spot prices, containing storage fees and interest, contango structure. But after yesterday, as violent suppression, if in coming days we witness an anomaly, COMEX futures prices continue weak, maintaining $86 negative 88. But in London or Shanghai physical delivery markets, getting spot requires paying higher premiums. Then the alarm officially sounds. What does this mean? This means paper price and physical reality officially decoupling. Watch COMEX inventory reports, registered versus eligible, ratio changes. If registered, inventory readily available for delivery, not only does T increase during price drops, but continues rapid outflow. That reveals one bone. Chilling fact, smart money is using low prices to loot clean exchanges' last physical bits. It is like long queues forming at bank doors, but bank managers broadcasting deposits are safe, interest rates still dropping. If you see this divergence, don't hesitate. This is markets issuing highest level evacuation signals, not evacuate silver, but evacuate that pricing system. For different participants, for speculators, traders, stay away from leverage. Current markets are meat grinders. Volatility will be artificially amplified to cleanse chips on both sides. If you don't have unlimited margins, don't try picking up coins before bulldozers. For savers must understand, hedging risk, meaning buying physical silver or other hard assets. Isn's T because you are certain. It LL rise to $100 next week. You buy it like buying fire insurance. You buy fire insurance not because you hope your house catches fire, but because you know this house's electrical system, monetary policy, has aged and overloaded. Current silver isn't T just a metal, it is a credit default swap CDS against fiat system credit default. When you buy a physical silver coin at $86, you are actually shorting those bankers trying to control you. You don't T need it to instantly surge. You only need it quietly lying in your safe as your wealth. S final, off-grid backup. Finally, let S extend perspective beyond next week, toward the end game. How will all this end? After $92, what awaits us? Many worry Wall Street as suppression will, like the past 40 years, again silence silver for a decade. But this time, mathematical laws will take over everything. We reapproaching a moment called physical singularity. In this world, paper gold and paper silver trading volumes are hundreds of times physical mining volumes. This game S prerequisite is most people only need seeing profits in accounts, not actually demanding silver bars shipped home. But when industrial demand unsolvable by printing money begins head on clashing with financial demand solvable by printing money, this prerequisite collapses. Photovoltaic panels don't need paper silver contracts to generate electricity. They need real silver atoms. AI chip packaging doesn't need future certificates. It needs real metal conductors. When the last registered inventory is withdrawn, when largest market makers declare force majeure, unable to deliver enforceably cash, settle, that will be price discovery mechanism as complete reset. At that moment, silver prices will no longer be determined by COMEX shorts, but by whoever truly holds the last ounce of silver. At that moment, $92 will no longer be ceiling, but become an extremely cheap starting line. So right now, looking at that suppressed price, don't feel anger, don't feel fortunate. You should feel fortunate. Fortunate that this system full of loopholes and lies, on this Thursday afternoon, gave you one last chance to board Noah, SARC at extremely low cost. This war hasn't ended, in fact, for the awakened, it is just beginning.